Good afternoon, everyone. Welcome to the Financial Shepherd Happy Hour. Hope you all had a great week. For those that may be tuning in for the first time for a happy hour episode, about 4:15, as often as we can on Fridays, we like to kind of summarize what happened in the markets this week, why did it happen, what do we get to look forward to here in the coming week, and maybe what does history have to say about the current environment that we're in. And it's been a really stellar start to the new year here in 2023, and also a really great week for equities as a whole. Also, some really good news regarding inflation as well, which we've now seen three consecutive inflation reports of falling inflation. And it's certainly going to have a major impact for the remainder of 2023 regarding what the markets are going to do, how the Fed's going to continue or decide to not continue to raise rates, which we believe would be prudent at this point. But we're all going to find out next Wednesday. So just to get us kicked off here, the S&P 500 for the week was up more than 2%. NASDAQ was up more than 4% for the week. So the tech sector is really, really driving a lot of growth here so far this year. I believe the NASDAQ is up around 10, 11% thus far here with just not even a full month to start the year. And of course, as we've all known, the tech sector, the NASDAQ, which is the biggest part of the S&P 500, is about 25% of the overall market. That was by far the worst performing sector for all of 2022, being down more than 30% in 1 year. Now, the Dow Jones Industrial Average, it was the laggard of the three major U.S. stock market averages, but the Dow was also positive about 1.5% for the week. Now, the big headline news, of course, was the inflation report that we received at 8:30 a.m. this morning. And inflation expectations, we're looking for a increase on the core PCE and core PCI, CPI, I should say, of 0.3%. And that's exactly the reading that we got. So I was hoping for actually a little bit lower number than consensus, but it was still, all in all, a excellent inflation report. It came right in line with analysts and economists' expectations, which is a big reason why we've had a really good start to this year, as well as this week, for that matter, because it really has to do with what the market expects the Fed to do based on the data that we're receiving. Now, the Fed said that they're data dependent. We're actually going to find out next Wednesday. So next Wednesday, February 1st, 2:30, Fed Chair Jerome Powell is going to come out and say, hey, we're going to raise interest rates by 0.25%. That's already baked into the market equity prices. If he surprises the market and does a higher interest rate increase, that's certainly going to hurt equities. You'll probably see a sell-off of probably significant magnitude because it's not priced into the market right now. They all expect 25 basis points, as do I. And we could be completely surprised. He comes out and says, hey, we don't need to raise rates at all. We're just going to keep them where they're at. That would, of course, be a great bit of news, and a very high movement in stock markets would be expected after that, kind of that violent hockey stick move up and to the right, which would be fantastic. And that's really what is holding the market back from accelerating, gains and growth to start this year. Is the market is saying one thing, that the Fed cannot and should not continue to increase rates. And the Fed and all the Fed heads, if you will, the 19 members that make up the Fed, are all saying something completely different, that they need to continue to increase interest rates. And we wanted to take a look at that in a little bit more detail for customers. And when we go back to the Fed FOMC meeting, the Federal Open Market Committee meeting back in December 2022, their inflation base case was about 4.8%. Well, if you look at the 2-year Treasury note right now, it's about 4.1 to 4.2. So there's about 60 to 70 basis points difference in what the market thinks the ultimate target that the Fed should have for interest rates should be, being at about 4.2. But the Fed thinks they need to be at least at 4.8 to make sure that inflation is completely squashed, diminished, and no longer a major concern. Well, the reality is all the data is falling off a cliff and flat out deflationary. The big lagger in the inflation calculation is housing. So owner's equivalent rent. And if you think about it, it makes a lot of sense that it has at least a 12-month lag effect. And we're just now right at about that 12-month window. So in February, March of last year is when we first started to increase interest rates here. So we're about at that point where in future inflation reports, you're going to start to see this really show up in the data in a big positive way, meaning more deflation coming from that housing sector. So if you're a landlord, you probably only have, a tenant lease agreement that lasts about a year. So you're only updating those things once a year. And as rates are going up, clearly, those costs are going to have to be accounted for. And you've seen the rents going up across the board. Now they're falling. Therefore, we would expect that to start to show up in the data here, which means the Fed heads and Fed Chair Jerome Powell is going to have to make a decision here. Are they going to continue to look at the year-over-year inflation number? So the year-over-year inflation number is 4.4%. So that's a long way that we've come down from a high of over 9% back in the summer of 2021. So it's certainly trending in the right direction. And if you take the November, December, and today's report here in January, and annualize that 3-month inflation data, you're looking at an inflation number right at about 3%, which is really, really close to the Fed's long-term target of inflation at 2%. So all of these reasons are why the stock market has performed exceptionally well. I also wanted to share with you all a little bit of extra data from some research that we did, is saying, well, the tech sector, although it's the biggest sector of the S&P 500, and certainly because of that, the most important, and probably will continue to grow as a bigger and bigger chunk of the overall market as we continue to automate in this country. If there's not enough people to do a task for an employer, whether it's a service or creating a product, then they'll simply spend money on figuring out a way to automate that. So they can automate the task, and that automation, whether it comes from software, robots, or some other piece of technology, that software doesn't need sick days or health insurance or all those other things. So it actually makes it more profitable for the underlying business, more efficient. And it certainly opens up that person that normally would have been there to do that task, frees them up for other parts of the economy and other sectors that they can now benefit from working into. So there's no longer a need for them at that other task that's now been automated. So that's how economies grow, become more efficient. And that's the expectation for the tech sector to continue to grow. But I wanted to understand, just because the tech sector is that big, that important, and performed that poorly in 2022, what is the correlation between easing financial conditions, meaning rates coming down? What is the correlation for things like technology and their performance in the stock market? I found some pretty interesting data. So the NASDAQ, 88% of the tech sector is very highly correlated with easing financial conditions. It's actually the most correlated of any other sector. So there's 11 sectors of the S&P 500. Again, tech's the largest. Tech has the highest correlation to easing financial conditions. So as interest rates come down, financial conditions are now easing. You should expect tech to be probably the best performing sector in the S&P 500, not just so far this year, but that's my expectation for throughout 2023. And the other sector in the S&P 500 that came in second, the second highest correlated sector, was industrials. And that's also been a focus of emphasis for us here at Shepherd Wealth Management and our clients. And part of our quarterly review was discussing the fact that we still need to stay overweight technology, but we also want to have more exposure to industrials. And industrials, that sector is about 9% roughly of the S&P 500. So we're trying to be a little overweight there. And we're really, really excited about all of the quarterly reviews that we do. And it's why we do them. That's why I think it's so important to have a quarterly review every single quarter, because there's a lot of stuff you can never control when it comes to investing your money, specifically over a short period of time and even over long periods of time. But there are one thing for sure you can always control is that asset allocation. And asset allocation is just a fancy way of saying this is how much of my money is invested, in stocks, bonds, and cash. And we are in full control over that. And that's why we do these quarterly reviews with our customers, is so that we can easily pivot and rotate. Let's say we continue to get the type of gains that we're getting in the tech sector. That's great. But if we're starting out with 30% in tech, and that's positive 10% in one quarter, we're already there in 1 month, really. So if we continue to see that sort of trend, that's great. We'll probably take some profits out and add to other parts of the portfolio, international being one of them, and of course, industrials and other sectors as well. So that's the short and quick version of what happened this week, what happened today, why it happened, what historical data has to say about the time that we're in right now. And next week is a major, major week for the economy and the stock market. So we have a whole bunch of tech earnings. You got Apple, Meta, Facebook, Google, Amazon, and a whole bunch of others reporting their earnings next week, on top of the Wednesday Fed announcement at 2:30 as to what the Fed is going to do with interest rates, as well as what they think they're going to need to do with rates going into the future based on the data that we have right now. And all the data is screaming it's about time for the Fed to pause and eventually start to pivot and reduce interest rates, which certainly is going to be a great thing for equities and specifically the tech sector. It's been a blast. I hope you guys enjoyed the show that we had for you here today. Don't forget to go to the website, shepherdwm.com. There's a spot right at the top. It'll take you right to our YouTube page. You can check out all the former podcasts that we have done and we'll continue to do. I try to do a bi-weekly, bigger 40-minute podcast. And of course, as often as we can on Fridays, having this little happy hour. So you guys can grab your favorite beverage and get a quick little recap of what happened in the markets and what to look forward to in the coming weeks. So it's been an absolute blast. I hope you guys have a great rest of your weekend. Hopefully it's a lot of fun time with family and friends. And certainly hope everybody's going to get a chance to watch the Cincinnati Bengals and the Chiefs at 6:30 on Sunday. I don't know, I'll be watching it. So go Bengals. And certainly look forward to catching you guys next Friday. A lot to talk about. So enjoy your weekend, and we'll talk to you then.